Hey everybody, Colin Harper with HPK Provident here with Brian and Mike as usual. Just forewarning, we have some spotty internet connections. I know Mike's down in Florida and his just got restored uh, this morning or last night, and Brian and I are both kind of out of the office today, so we've got a couple things going on there. Again, thanks for joining us. We're going to talk a little bit about the markets and a little bit about planning, but I think there's a hurricane down in Florida. There's been a hurricane in the markets. Mike, I'll kind of kick it over to you. But before I do that, nothing we talk about here is a specific recommendation. If you have questions, we would definitely encourage you to reach out. We'd be happy to chat with you about your specific situation. But nothing we talk about here is a specific recommendation, just our general observations on what we see going on in the market and that environment. Mike, it's been a rough couple weeks. It seems like, and it looks like we may have just lost Brian too. I know he was having some trouble with his internet connection while he's traveling for hockey. Well, I know other than the market being excited, Florida was about to get wiped off the map earlier this week. It's been a pretty bumpy road. What are you seeing on that front, Mike?
Yeah, well, with the hurricane, first off, Sarasota fared fairly well. Originally, it looked like it was going to hit us directly, but ended up cutting into land a little sooner. So that was really good news for us, but not so much for the Fort Myers area. Around here, we just had very high winds. We probably got above 100. Just a very stormy day. No internet most of the day. Just sustained winds for about 6 hours. So wasn't too fun, but I got a little bit of reading done in my CMT book and watched out the window quite a bit.
Perfect. Yeah, just on that note too, thoughts and prayers with all those families that were affected. Yeah. And huge thanks to all our clients who reached out to see how our Sarasota office was doing. We appreciate that more than you know, and everybody on our side's doing just fine, minus some minor wind damage. And Mike might not get some mail for a few weeks.
Yeah, my mailbox has seen better days.
His mailbox has definitely seen better days, and it looks like we've got Brian back now too. We were just talking about how Mike didn't want to get mail for a few weeks from his missing mailbox. So,
well, there's usually just advertisements and whatnot, political advertisements in particular right now. So you're not going to miss much, Mike.
All right. Just let me know though. But yeah, it wasn't the hurricane that Jamie Dimon was talking about, but we'll see with that. But on to the markets. The week of trading, we kind of just bounced around relatively the same level as the lows we hit in June. We made some marginal new intraday and closing lows, which isn't great technically, but it's still in the same ballpark of that support range. So unless we definitively undercut those levels, I still count that as support. What that shows me is people are willing to buy at these levels. So hopefully we start to create a solid base from here and trend higher in the coming weeks. However, there is a risk that we break through that on the downside. And from a technical picture, the next support's probably about 3% lower, and then the one below that's 5 to 6%. I'm not a big believer that we're going to go much lower than that, considering once you get down close to 30% in the market, a recession is pretty much priced in that at that point. And I still don't see a severe recession scenario occurring next year, just with the current economic data. That could change, but we're just in a very good starting place. So throughout the week, we had that huge bounce on Wednesday, and it wasn't because of the hurricane. It was because the Bank of England came out and said they were going to buy bonds. So maybe U.S. market participants hope that was a precursor of what the Fed may do in coming months. I don't really think that's realistic, but I also don't think that the Fed gets to a terminal rate of 4.6%. And if they start to pause before that and see what happens with the economy, I think that would be very welcome by markets. But unfortunately, that rally on Wednesday, we gave it all back yesterday. Today, it's a very uncertain trading range today. It's been up 0.5%. It's been down 0.5%. So people are just kind of waiting to see what happens, see if we hold these levels. But hopefully we continue to build on that. We did get some economic data this morning. We got the Fed's preferred measure of inflation, which is the PCE deflator. It showed that inflation is still too hot, but we knew that. We got the CPI report a couple weeks ago, so we were prepared that it was going to be another hot reading. But it's important to note it's a lagging indicator. And I hate when people talk about that, but now we're starting to see some of the leading indicators show that some components are coming down. You look at the broad commodity basket, that's really fallen off a cliff. Some of the survey data, such as the manufacturing prices paid, that's been trending lower for a month or two. Supply chains seem like they're starting to ease a little bit. So that should lead into CPI at some point. I'm hoping that the Fed starts to look beyond just the headline number and I mean, they're aware that a third of that's made up of the rent component or owner's equivalent rent. And I think how they actually calculate owner's equivalent rent, they go out, to my understanding, and survey people and ask them what they think they can rent their house for. So obviously everyone's going to inflate that a little bit.
It's a great metric.
But yeah, I really think we might start to see some declines in inflation in the year end, and with midterms being behind us, could set us up for a really nice rally. And if inflation starts to come down, the Fed can pause, and we start to see a very different investment landscape. It's been a brutal year. I think this is one of the worst years for a 60-40 portfolio ever. I just heard on the halftime report the average 60-40 is down about 20%. So it's been a difficult environment. No place to hide but cash. Luckily, we still have some cash in the portfolios.
Nice. The 60-40 portfolios have been down. I think the question to contemplate is that concept of a balanced portfolio, is it gone forever? Now that sounds extreme and ridiculous, but extreme ridiculous commentary kind of dominates the news. I got my own opinions on that. Mike, you're certainly more studied and qualified on that. I mean, do we need to pull the 60-40 sail down, if you will, and come up with a completely different tack on how we're going to get across the waters?
Well, if you look at a 60-40 portfolio today versus a year ago, it's a lot better picture. You can go out and get bonds yielding 4 or 5%, high quality. You go out on that scale, high yield, you get up to 9%. You can get a 2-year treasury for over 4.15 right now. So if you buy the individual bond, which we're not recommending or anything, but you hold that to maturity, you don't have the interest rate risk. So there's places to hide. So a 60-40 portfolio is starting to look a lot more attractive. A year ago, stock valuations were 23 times forward earnings. Today, they're about 15.5. So it should. I don't think the 60-40 is dead.
Yeah, I don't think so either. Go ahead, Colin.
I'll play devil's advocate and say, it is dead, right? We had those bonds there, and then this is kind of a little bit facetious, but say the 60-40 is dead, and we're really concerned about the bonds we had in there for protection not doing well. I think Mike brought up a great point. It's how those are structured. So if you actually own individual bonds, you're not really bearing interest rate risk, because if you hold them to maturity, you're getting what you paid for them back, or that par value, which I think is something that gets lost quite often. And so, you got your bonds down somewhere between 10 and 15% because of interest rate sensitivity. Keep going. See, this is why Mike's here to correct me when I say dumb things.
Yeah, I think a U.S. aggregate, which is mostly treasuries and MBSs, is down about 15%. I think I saw investment grade corporates are actually down about 24. I think high yield's down about 18. So yeah, it's been a terrible, one of the worst years for bond investors ever.
And so that point is 40% better served in another avenue. And there, are a couple other things to look at. I would say there's a lot of products on the market now that offer what they refer to as buffered strategies, where it allows you to build in some safety, like downside protections tied to specific indices. So I would say I would agree with you guys. I don't think the 60-40 is dead, but there are other ways to protect against downside that in a rising interest rate environment may be more attractive for some people. But like you said, if you're owning individual bonds and you're holding them to maturity, that will serve its purpose very well, especially as things start to improve and look better here. But just a lot of painful hits on the bond side that are typically there to protect assets on the way down and be negatively correlated with the market.
I got to tell you, it seems to me the real estate market is kind of the opposite of many other markets, and we'll call these the securities markets, stocks and bonds, in the sense that everybody's rushing out at very high prices, buying a lot of real estate and very excited about it. And many people aren't as excited to run in and buy stocks and bonds at very, very low prices. And it's kind of interesting to me. And I see that switch happening over time. I think that folks are going to realize that given the right time frames and the proper planning, which we talk about all the time, these prices are much, much lower than they have been historically. To Mike and Colin's point, that whether it be stocks or bonds, and so it's curious to me as a planner looking at an overall picture how many people are so willing and excited to pay incredibly inflated prices on real estate, yet don't have the same level of excitement of getting what could potentially over time be an extraordinary bargain. For many people, depending on your lifetime, it might be one of the last great times before whatever your goal is. Now, if you got 30, 40 years, you'll probably have many great entry points into the stock and bond markets. But I hope to see, and again, this is a function of planning, time frames, the risk tolerances and the things that we talk about. But I hope to see the equivalent level of excitement to buy something that has been historically low, many stocks, many bonds, and hopefully see the appreciation over time as a similar level of excitement with people that are willing to pay 30-40% for a property than they would have a few years ago.
Well, I can't Airbnb my stock portfolio, Brian.
That's a good one.
That's
maybe
I've had that conversation a lot recently, and that's been, I think that's really that's driving a lot of investment property sales. Is everyone hears all these great success stories about, I'm going to buy a property out and Airbnb it, which for some people that is a fantastic way to build wealth. There's just a lot of work and some things you need to do on protection, but that's what instantly came to mind for me, right? The real estate market's changed a lot, and people, it is remarkable how much people, in my opinion, or even myself, right? A lot of people are moving because they need to, and that's more of a life decision than a financial decision, and that makes perfect sense. If you're in that boat and you need to move because life circumstances dictate it, then by all means. But I am very interested to see how that plays out with people, specifically going after investment properties at very high interest rates, where we've seen record inflation in the housing market. So that's a great point, Brian. But yeah, if you figure out how to Airbnb my stock portfolio, just let me know. It'd be much more attractive at that point.
I think you maybe came out on a new industry that we'd have to contemplate, how to develop that. Maybe somebody could, utilize my portfolio for a couple of weeks or something.
You want to own we can rotate. Do you want to own the 5 most popular stocks this week? Just, rent them out from me. Great.
The kind of and we allude to this quite a bit, and we put some of this out on social media. It's now is a great time, always is a great time to create or re-emphasize great habits. We talk about habits. The easiest example I think is losing weight. Right, you start slow. You're not going to reach your weight goal overnight. Many people try that and say there's a pill for it. There's really not. It's a function of creating habits, and I have seen various studies that say it takes 6-7 weeks to create a habit. Some people will say it'll take 7 months. But creating those good habits of, hey, let's invest on a regular basis, the ups, the downs. Let's understand what our cash flow situation is. Let's see what we have available to move ourselves towards our financial goals. You create that habit, and 6-7 months from now, you'll be rewarded. You'll be rewarded in a couple ways. One, if you're investing on a regular basis, this could be through a retirement plan at work, say a 401k, a simple SEP, those types of things, 403b for some of you, 457s for some of you. Eventually you just don't miss that money that you're putting away as a function of habit. You can do that outside of your 401ks into a regular investment portfolio. Then you wake up one day and say, oh my gosh, this actually worked. It's kind of like losing weight. You start to eat regularly and exercise regularly. You don't see it right away. As a matter of fact, you might see the opposite, which is kind of what I see most often. I see that, oh my goodness, I'm gaining weight here. What's happening? But then, whatever that time frame is, months, years into the future, you look back and say this worked. And if I can, play out that the weight loss, if you will, with the market, we got a lot of weight to lose, so it could be pretty easy. Markets down, not markets down a whole bunch, could be relatively easy. Who knows? We don't. We're not making this prediction. Certainly, nobody can know what's going to go on in the future. But the fact is, things are down, and you have the potential to succeed, a greater potential to succeed when the markets are down. Kind of like you got a greater potential to succeed if you have a lot of weight to lose, but you got a greater potential to succeed over time than at many points in the last decade, maybe, because things are down. So your likelihood of succeeding by creating those good habits, save on a regular basis. Planning concepts have not changed. Save as much as you can, as often as you can, for as long as you can.
So what you're saying, Brian, is I should start eating a lot and packing on the pounds, right?
Well, yeah. Well, we're coming towards Thanksgiving and the holidays, and January 1st is a magic day. So if you bulk up around 20 pounds, it could be by the end of January or March, you're down 10, and you say, "Look at me, I lost 10." Now you gained 20, and the holidays. Yeah, that's what I'm saying.
Well, somebody's been working on their before picture. Somebody's been working on their before picture for about 4 strong years now. I can definitely relate to that, and I think that's a great point, Brian. Whenever we deal with planning, we always focus on the known things, and our topic was try to work on planning and increase productivity. And I think one of the tools we've used in our practice and had a lot of success with is something known as time blocking. And it's really when you take your known variable, your time, come up with a list of everything you need to accomplish, figure out when you're the most productive during the course of the day, and prioritize those tasks and really cut down on distractions. I keep seeing Amazon ads for, little Amazon ads for those little productivity timers you can put on your desk, and then it'll like blink at you when your time clock's done for that little segment. But that's kind of on the planning side of things. Deal with the knowns, the known being time and what you need to accomplish that day, and really look at doing some time blocking. I'd say from personal experience, we've had a lot of luck with that in our practice. Even specifically, we get a lot of incoming calls from folks, and we're not always available to take them, but we block off specific time during the day to return those calls, and we have somebody kind of on call every day to do that. So that's one simple idea you guys can take with you from this to work on. I would say there's a ton of great resources. We're not the experts or the authority on time blocking, but knowing from personal experience, it's had a very positive impact for us.
Yeah, it clearly has. And absent of that, you end up with a whole bunch of things on your plate, and you kind of get to your end of your time frame, whether that be a day. You get to the end of your day and say, "Oh my gosh, that went by quick." It's incredible when you start to segment things out, mentally, than with your time, and then you could do that over longer time periods with your financial planning as well. You segment those things out, and you don't feel as anxious. You feel a little bit more control. And you can certainly do that in the financial planning as well. You can say, well, hey, I know what my plan is. I know what I'm working towards, and I know what the steps are. And you just continue to, take those steps. For a lot of the folks we work with, when we, talk about the finances in particular, that really has helped tremendously to relieve a lot of near-term anxiety. And there's a lot out there, right? You got Russia, you got elections, you got inflation, and all these other things. But when you have that end in mind and your ultimate goal, a lot of the immediate noise that comes kind of across your desk, comes kind of across your life, isn't as distracting, because you have segmented out, whether it's the time in your day or segment out what you want to accomplish in your financial life. It actually works. And then you spend a lot less time on CNBC and all those other shows, getting all worked up about what could be, should be, might be tomorrow, when you know that you're looking at weeks and months and years into the future. It's hard to do. Hey, let's face facts though. Hey, it's hard. It's hard, and that's where we come in. Part of what we're doing is, in our practice is we're kind of accountability partners. Hey, this is what you have indicated is a high priority for you. We've outlined a couple steps. We've given you some options. We've picked a path, and if you come to us and say, I'm jumping off the path. Well, if your priorities change, then we certainly understand your time frames change, life circumstances change. But if those goals and those the resources that you have and if a lot hasn't changed, we step in as that accountability partner and say, hey, let's reframe this. Are you really changing your goals based on what happens in November? You're going to change your life goals based on what happens in November. If that makes sense for you, we're going to have a discussion. If it isn't, that's where we come in. That becomes a big part of our job, quite honestly.
And Brian, I think those are all great points. And Mike, certainly appreciate the input on the markets. I'll leave us with a quote that kind of sums up a lot about what we're talking about right now. It's you can measure opportunity with the same yardstick that measures the risk involved. They go together. And that's, very true. We're talking about how there could be some good opportunities here, and they also correlate with some risks. So helping folks we work with understand that risk and the opportunities is something we really enjoy doing. So, we'll leave you with that on this Friday. Thoughts and prayers to all the families affected by that hurricane. Like we said at the beginning, everybody on our crew checked in A-OK, minus a missing mailbox and a couple screens on the lanais. Everybody's doing okay, but I know there was a lot more that were affected much more significantly than our immediate circle. So thoughts and prayers that way. And look forward to catching up with you all next week. If anything comes up, feel free to leave a comment, shoot us an email, visit the website. We'd love to have a chat with you if anything sparked your interest today. But in the meantime, stay safe, everybody. Have a great weekend.
A good weekend.
Thanks, guys.